Hey there, my name's Francis Hunt, and today I'm looking to talk to you about monetary policy and fiscal policy, what these two concepts of economics actually mean, and how they pertain to where we are naturally in our current economic environment. So let's start right at the beginning. When you hear government ministers or major economic people such as the head of the Fed or the Bank of England referring to monetary and policy and fiscal policy, what are they referring to? So let's start with monetary policy. Monetary policy specifically deals with the cost of money, and the cost of money is an interest rate based price. In other words, if someone is borrowing, how much will they pay for the use of those funds? And often, to the counterbalance of that, a lender, what is he asking as a price for making his funds available? Now, typically, the banking system has as the banker of last resort the central bank of that country. So our banking system is obliged to hold certain reserves with the central bank to prove that they're liquid and that they're in a position to trade and have sufficient financial backing. Their overnight deposits are pledged with the Reserve Bank, and they get paid an interest on that. The central bank, or Reserve Bank as it's may be known, is also the lender of last resort to banks when they are having short-term cash surpluses or shortfalls. In other words, they will deposit excess with the central bank, or they will request additional liquidity. Now, the rate that they borrow from the central bank is the determined bank rate that gets spoken about extensively in many countries. And the Fed lending rate, for example, in the US is 0.25%, and over here in the UK it's 0.5%, and in the Euroland it's 0.75%. That is the rate that banks can borrow from the central bank and the rate of interest that they'd be obliged to pay. So this is all about controlling the price of money. Sustained periods of very low interest rates sees an excess of lending. And this is what happened under the Greenspan era. Succession of minor crises and some major ones saw him continually using monetary policy, in other words, reducing the cost of credit to pump cash into the system. And what actually happened is we had a surplus of liquidity, and the risk that goes with the borrowing, because it's also, the interest rate is also meant to reflect a price of risk of loss, started to disconnect and decouple from the actual risks. And when you have a lot of money chasing a few opportunities, those opportunities get overpriced. There's too much competition chasing after them to participate, and there's too much speculative money chasing risky assets. And this is what happened in the run-up right the way through the dot-com boom up to 2000, and then the secondary massive cuts in interest rates that led to the housing boom, which made borrowing very cheap. So monetary policy, what other tools does the central bank have outside of the interest rates and setting the interest rates and pushing them up if people are getting too exuberant, which was supposed to happen but probably didn't, and dropping them when we are have lost all confidence? They also have the ability to up the amount of reserves that a bank holds, so the reserve ratio, and forcing a bank to be more stable, more solid, and bigger financial backing. So reducing the amount of leverage. For every pound that a bank gets deposited, they can often lend 10 times. So this ratio and these reserves are also tools that see and control the access, the price of credit, and the amount of credit. So using a reserve ratio might change the amount available. It doesn't change the price. Changing the interest rate that you pay and you demand if the primary commercial banks are taking money from the central bank does push up the cost. So if the central bank ups rates, the commercial banks have to charge more on their cards that they are giving credit to clients to, and at the same time paying more to their depositors. So this takes some of the excessive liquidity out of the system. So monetary policy is controlled normally in the UK, for example, by the Bank of England. There's a policy, a team called the Monetary Policy Committee, and it has all the key heads, usually people highly qualified in economics and responsible for being the economic brain trust and for implementing policy, and recently was decoupled from political control. They used to be controlled by the power the party in power in the UK. The Federal Reserve System is how it works in the US, and the ECB is how it works in Euroland. So these people are meant to be apolitical, meaning that they don't subscribe to any particular view, but they're doing the right thing by the citizens for the economy in question in terms of how much credit has been available, what confidence is like. They're also targeted on inflation. This was the primary focus of monetary policy, was to target on inflation, and this is the stated constitution, if you want, for central banks. However, recently it's become quite clear that inflation is secondary, and given our massive amounts of economic weakness that we're facing in the globe, there now appears to be a hidden remit in a practical sense regarding stimulating growth. And this is where the quantitative easing policies, which is once again flooding the market with more cheap and easy money, is here to stimulate growth and is actually counterproductive for future potential inflation. In other words, currency destruction is by definition inflation. So if you think of Zimbabwe, a loaf of bread made in South Africa sells for an obscene amount in Zimbabwean dollars and a stable amount in rands just a few miles over the border. The condition is not the shortage of bread, it is the devaluation of the Zimbabwean currency. This was done because too much was printed. And we are currently in an environment where an epic amount of quantitative easing and printing is going ahead. So this makes monetary policy very, very interesting.